So we've been having a pretty magnificent rally in the S&P 500. It's up over 17% on the year, but this is a pretty interesting chart that shows that most of the performance was actually due to a lot of the companies that have exposure to AIs, companies like Google, like Microsoft, like Nvidia. You could call them the Magnificent Seven, but there's a lot of stocks within the S&P and outside the S&P that have actually been left behind. A lot of them are actually dividend kind of stocks. This is why I've been doing a lot of videos on them lately, because I believe there's an opportunity in this area. I'm not a dividend investor, but if I find opportunities within dividend stocks, I'm going to look into them. I'm open to any kind of opportunities that could potentially make me some kind of a return in the stock market. And in this video, I'm going to analyze Verizon, because I believe, Verizon is looking pretty interesting. It's sitting at its 2011 price. There's a lot of pessimism around this company, and I put this circle here. This is when Warren Buffett actually sold it. He pretty much timed it perfectly after he got out of his stake in the first or second quarter of 2022. The stock has been going down since then, and now sitting at $34 per share, and it's actually yielding its highest dividend yield pretty much since 2012 of something pretty close to 8%, or around 7.8% to be exact. So pretty close to an 8% dividend, and I believe the dividend is well covered. So there could be a lot of kind of room to make a lot of returns with Verizon, not only with the dividend, but also on some kind of a comeback for the share price. I'm going to take a look at all of that in today's video, analyze why the stock is going down, what kind of problems are they facing, will there be a dividend cut or not, if the dividend is safe, and if it's a good buying opportunity in general or not. So I really hope you enjoy this video. Now, one of the reasons why Verizon is going down, and this is a big problem they're facing, is the company does have a lot of debt. And this is a big concern, and especially right now, people were not talking about the debt 2 or 3 years ago because we had 0% interest rates. But now, as interest rates have gone up from 0% to 5.25%, a lot of investors are now suddenly looking at the debt profile to a lot of those companies, and this is something very, very important to watch. Now, in 2019, the company had $100 billion of long-term debt, and now they have $143 billion, over a 43% increase, while the free cash flow was pretty much going down in this period, which, to me, is something that's a pretty bad investment in general. Now, the company did operate with a lot of leverage on a historical basis, around $100 billion, and it should operate with a lot of leverage because of the predictability of the business model. The free cash flow from those telecom and businesses and stuff is pretty resilient in my opinion. So they should operate with a lot of leverage, especially for their CapEx spending and a lot of the other expenses they have. But I believe the leverage have been getting out of control for Verizon, for it to go up over 43% from 2019 to 2022, while the free cash flow was actually going down. Now, this is a pretty interesting figure, that even though the long-term debt went up 43%, the interest expense for Verizon actually went down. It was $4.7 billion in 2019, and now sitting at $3.6 billion, and this is thanks to the management of Verizon. They were able to take advantage of the 0% interest rates in 2020 and in 2021 to refinance a lot of the debt at much lower rates. This is something good. They took advantage of it. A lot of other companies, they did not take advantage of it. We talked about American Tower and a few of those kind of stocks, but Verizon did take advantage of it, and this is something good for the company in general. Now, if we look at something that I want to talk about, and I talked about it in my video before, and this is with these kind of stocks that have very bad sentiment, the share price is going down every single day. You normally need some kind of a catalyst or some kind of a turnaround or some kind of a switch, maybe a new CEO, maybe some kind of the losses are troughing or the free cash flow is going to improve, or some kind of a pivot or inflection point that's really going to change the sentiment around the company Verizon, and it's going to cause the sentiment to go from extremely pessimism to some kind of optimism. And this is how you have these moves like Meta, like, even Apple, a lot of these kind of stocks, even Nvidia got pretty euphoric. But this is how powerful the sentiment is, and it could just go from extreme pessimism to beyond optimism, like what happened with Nvidia. You normally need some kind of a catalyst or something to actually happen. And the catalyst, in my opinion, and the massive kind of inflection point is actually their CapEx spending. They have been doing a lot of investments in, a lot of the areas of their business for heavy CapEx kind of stuff. And the CapEx expense was increasing while the free cash flow was actually decreasing. But now, as they pretty much finished their investments in whatever they were investing in, you could look at the investor relations page and, look at their investments and stuff. I'm not going to try to make the video too long, but they're going to reduce their capital spending by $5 billion to $17 billion by 2024. Now, this is pretty massive for the company. And if you look at the free cash flow expectations, it's expected that the free cash flow has already troughed in 2022. It has been declining from 2020, and it bottomed pretty much in 2022. The free cash flow is already improving. You could look at their latest, earnings report, and even the one before. The free cash flow is starting to improve, and this is mainly because they are reducing their CapEx spending because they already did the investments that they wanted pretty much to do, and it's expected to go from 14 billion to 16.8 to 18.4, even up to $20 billion by 2026. Now, I'm not counting on this $20 billion number, although it could be pretty amazing. But if the free cash flow goes to 16.8 billion, a lot of things are going to change with Verizon, and mostly is around, the dividend. Now, most of you are worried about the dividend. I believe the dividend is safe, because even though we're looking at this $14 billion number, Verizon still collected $14 billion of free cash flow, but the dividend paid was around 10.8 billion, which leaves around somewhere around the $3.2 billion margin for, if Verizon wants to increase the dividend, or is 3.8 billion for Verizon to pay down some debt or do other things with the business. Now, if the dividend stays around 10.8 billion or even 11 billion, and the free cash flow goes to 18 billion by 2024, because they're going to reduce the CapEx, then Verizon is going to have $7 billion of extra free cash flow every single year to start paying down the debts that we looked at, which is getting out of control, is sitting around the 143 billion. They're going to have $7 billion after paying the dividend to actually start paying down the debt. And this could cause a massive, massive change in sentiment, in my opinion. It could cause maybe some kind of analysts to actually upgrade the stock, because they're going to see that now Verizon is actually able to pay down the debt, and they're going to be able to do that if they, continue on their promise of reducing the CapEx. And when they reduce the CapEx, the free cash flow is going to grow. And if the dividend is around 11 billion and the free cash flow is 18.4, they're going to have, an extra, something 6 or 7 billion, even a little bit more if it ever goes to 19 or 20 billion. So this is the kind of inflection point that I'm talking about with Verizon. I talked about it in my previous video. Now, the biggest problem with Verizon in the short term is, again, in their debt, because they have around 9.2 billion maturing in 2023. They do have some cash, and they have some of the free cash flows. They might be able to deal with it, but they have $16.2 billion coming up in 2024. There's no way in the world that Verizon is going to be able to pay this $16.2 billion in 2024, which means they're going to have to refinance it later on for the future, and it's going to have to be at much higher interest rates. And this might actually even hurt their free cash flow as their profitability in general. But they do have a lot of near-term maturities, even the 2025, even after they reduce the CapEx spending. They cannot meet the $8.7 billion payment. So if they do want to keep the dividend, and I believe they do want to keep the dividend, they're going to have to refinance all this debt pretty much to a later date, and this might cause the interest expense to increase a lot, and it might hurt the profitability in the short term. Now, the good news is that most of the debt, which is around $100 billion, is due after 2027. So nothing crazy in the short term, but this $16.2 billion, there's no way in the world Verizon is going to be able to pay it in 2024. It's just impossible, unless, mean, something big happens or they sell some kind of asset, which I'm not sure how they can do that. They're going to have to refinance it, and then the interest expense is going to increase. But for me personally, I believe the dividend is safe for the short term if they can refinance those near-term maturities to a later date, and I believe Verizon can actually do that. But if they can't do it, then the dividend could be at some risks. But I personally believe, it's, somewhat safe for the short term. Now, if I look at what Verizon is pretty much priced at, it's priced around 7.5 times free cash flow. And this is very, very low on a historical basis. The mean market cap to free cash flow for Verizon was around 11 times free cash flow, and now it's sitting at 7.5 times, and it's largely due, as I said, to the near-term maturities with the debt, but it's also due to, the discount rate because of the dividend. Why would you take 7.8% if you get a risk-free 5.25 or 5.5, buying short-term treasuries? But this is normally the best time to be buying these companies because interest rates are not going to be 5% forever. Even the Feds themselves, they said that the neutral rate is around 2 to 2.25 or 2.5% or something in the 2% range. So if the interest rate goes from 5% to 2%, 2 or 3 years from now, this near 8% dividend for Verizon is going to be very, very attractive, and it's going to go down, which could lead to a massive share price appreciation. So this is the value proposition with Verizon. But I personally believe, looking at the dividend and looking at where the company is priced at, I believe the company is still somewhat undervalued. There's a lot of risks with the maturity of the debt. If they were not able to refinance it, then we could potentially see a dividend cut, kind of like what AT&T did. Although I don't believe Verizon is going to do that, but it's possible that if they can't refinance, then they're going to eventually have to cut the dividend maybe 2 or 3 years from now. But in the near term, I believe the dividend is somewhat safe. What I do personally with these investments, I would, for example, buy Verizon. I don't own it, but this is an example. I would buy Verizon, I would sell covered calls on the company, I would collect the 8% dividend, and then I collect a premium on top of it. In total, I could yield 14 to 15% every single year selling covered calls and collecting the dividend on Verizon. And if Verizon goes down, then this is good news for me because I can buy back the covered calls I sold for much cheaper and collect the difference, and then I can sell them again whenever the stock goes up. This is what I normally do with a lot of those high yield stocks. I talk about the strategy in my own investment group if you're interested in joining, but I still believe Verizon looks interesting at such prices, but I would pay close attention to their debt situation and what the management actually says in the next quarter or two. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.